All right, check, check, radio check. I want to thank everybody for taking time out of your busy schedules to join us. Before we get started, if somebody wouldn't mind typing into chat that you can hear my voice and see my screen, let me know we don't have any technical difficulties. That would be great. And Harold, thank you. All right, so today's topic is going to be on something I call the qualified plan move. This is, sort of off the back of last week's conversation, which was the tax master. And some of these slides may seem familiar. Maybe in the past, if we've had conversations, maybe you've been on, they cross-pollinate between topics. So as we start to go through this, just I try and keep it at a high level so that what we're viewing we can wrap our head around. So without further ado, let's go through some things that I think are important. And the first is, this gentleman here, arguably one of the smartest men to ever live, has been quoted as saying one of the hardest things to understand in the world is the income tax, and specifically the U.S. income tax. So I put this slide up. This is not the running version, but I just wanted to bring to your attention just in over a year. I did this snippet last year and we were at 32 trillion. You can go here and see a real running clock, usdebtclock.org. But now look at 1 year later, we're at 34 trillion. So, I mean, we are on a trajectory that is problematic, right? And then this is the total debt, almost 100 trillion. And then, I noticed that we collected more than last year in tax revenue, and that should, in and of itself, should start to raise the flag. So we were at 4.6 trillion in tax revenue last year, and we're collecting more, which means that they are able to collect more from more sources, or for whatever reason, the tax revenue that was created just should put you on notice of saying that the tax man will be coming. So one of the things that I talk about is, I find that a lot of people get the deer in the headlight looks as we talk about taxes. And I've gone over this before, but you have to understand that not every dollar is taxed at the same tax rate, right? So the graduated cylinder to the right is, and this is what we call marginal tax brackets. And you'll see that the graduated cylinder to the right is 2023. And so we'll start at the bottom 10%. Anything over $23,200, the next tax bracket is 2% up until 94,300. But I put some text to the right-hand side, which is this is already tax law. And what's going to happen in a little over a year, right, is you are, almost 2 years from now, on 1/1/2026, the Tax Cut and Jobs Act will revert back to the 2017 tax environment unless Congress acts. And basically, you can see that just going back to the left, they lowered the threshold on the 10% and then the 15%, and they lowered the threshold. So all these numbers, basically, it's almost like a stealth tax, or they're getting back into an arena where they will be able to collect more tax revenue. And that is relatively low, historically speaking. We'll talk about that. But the purpose of today's call was to talk about something called qualified plans, the tax master move, right? So as we think about qualified plans, this is a term that is sort of in the financial industry, we have our own verbiage, our own language, and quite often the documents are complex, terms are thrown around, and I've been doing this for years. I mean, decades, and I still have to go look some things up. So what I wanted to do is just start with some definitions. So when we think about, say, traditional things like traditional IRAs, so in essence, on its high level, basically what we're doing is we're saying, and this is how I explain it to somebody, if we're earning 100 grand a year, that's reportable wages. What the IRS has said is if you defer, if you squirrel away up to 7 grand for 2024 if you're under age 50, and up to 8 grand if you're over age 50, you only have to pay tax. So let's assume you're on this call and you're over age 50, that you could only pay tax on 92 and take the 8 grand and put it off to the side and pay tax in the future. That's how traditional IRAs work. So that's basically the Reader's Digest version. A 401k, a lot of us are familiar with. The 401k, sometimes referred to as a COTA, cash on deferred arrangements, is a type of profit sharing plan, also a defined contribution plan. Participants have a choice to either one, take the company contribution in cash, or two, defer a portion of their current salary with a salary reduction agreement into a plan on a pre-tax basis in this tax sheltered account. Like profit sharing plans, there is a government imposed limit to plan participant compensations. And this is a lot of times there's something called with the 401ks called top heavy testing. So highly compensated participants, and that's typically owners of corporations, are limited to how much the plan will allow them to defer based on the deferrals of non-highly compensated participants. The formulas for this, I will tell you, are complex depending on the rules. That's not the purpose of today's call. What I did want to say, though, is that right now you're able to put away $23,000 if you're under age 50, and then you're able to put away another $7,000 if you're over. So $30,000 a year you could put into a tax deferred plan. Now, a thrift plan, I call them TSPs, but if you work for the federal government, they work almost identical as a 401k. So these vehicles are all tax deferred and they follow and they all really work very similarly. But one of the ones that I find that I run across, and we just had one of our advisors out in Chicago. The guy was a small business, right? Less than 100 employees, but he had decided to, and part of the selling of the arrangement was to create something called an ESOP, which is an employee stock ownership program. Now, what that does is it makes the employees, gives them an opportunity to become owners in the company. And this gentleman took his business and it became worth I think almost $30 million. So, several features make ESOPs unique as compared to other employee benefit plans. First, only an ESOP is required by law to invest primarily in the securities of the sponsoring employer. Second, an ESOP is unique among qualified employee benefit plans in its ability to borrow money. The contributions can be made in cash, but in an ESOP, they can actually be made with a company stock as well. Again, the purpose of this was not to make us CPAs in the arena of retirement plans, but help us understand. So SEPs, self-employed pensions, pension plans, defined benefit, right? Those are pension plans, defined contributions, profit sharings, all these things that the government, KIOs, you don't see those much anymore. Roth IRAs, we're going to talk about that. The Roth IRA, established in the Tax Relief Act of 1997 by Senator Roth, allows tax. It was drafted by or proposed and sponsored by Senator Roth. Allows taxpayers subject to certain income limits to save for retirement while allowing this savings to grow tax-free. Taxes are paid on contributions, but withdrawals are subject to certain rules, are not taxed at all. And this is the promotion. This is just Roth IRAs. Think about now when one of the strategies that have now become mainstream is a lot of 401ks have introduced a Roth 401k proponent or component. So we're gonna explore how some of this works. But really the question that I've asked folks in the past, when you hear the term qualified plan, right? They do two things. First, they defer the taxes. That's what we were just talking about. But, and this is an important but or an important and, they defer the tax calculation. And the way that I've framed this with folks before is, let's say, think about it like this. Let's think about it in the form of your mortgage. If I told you I was going to lend you money for your house, I'm not going to tell you the terms of the loan, and I'm not going to tell you when I'm going to call the note. How interested are you in that deal? And most of us would probably not enter into the arrangement. Um, Solo 401ks, do you advise on those as well, Gene? So the question, that depends. It depends on the cost for me. Solo 401ks are certainly a start, but I think after we go through a couple slides, you'll see here that's a great segue question into, when we defer our income to be taxed later, that goes back to the question, like, what is the tax environment going to be when I defer, when I take it out? And that's really the $1 million question. I think of defer as another, I'm not promoting, capital punishment. My dad used to, tell me to go get the belt. If I was in trouble, I got a whooping. And I would take the longest possible route to get that belt. And so when we defer, when we postpone something, typically they have negative consultations or consequences, right? So that's why I emphasize, all things tax deferred. I question the wisdom to do that. And if we're going to do something like tax postpone, right? So to your point, Gene, solo 401ks, I know of strategies and I've been promoting strategies for years. They take a while to build, but then they're tax favored and ultimately tax free. But before, I'm not here to talk about, here's the questions you have to ask yourself. And this is what the bill of goods that all the accountants, the CPAs, the people of that drank the Kool-Aid 30 years ago, went to accounting school, business school, they were all taught when these were first introduced, oh, when you get to retirement, you're going to be in a lower tax bracket. And we've been through that conversation before, and that's the horse race. And if that is true, then that advice was correct. But you have to ask yourself, with the writing on the wall, is that even likely? So have we made an error by deferring into the future? And we're going to explore that. So what tax bracket will you be in at retirement? And then what deductions will you have? We've lost all the deductions. So that brings me to tax thresholds, tax history. So a lot of folks are not familiar with our income tax history. And I'm just going to take a couple minutes to point out some things. And on this slide, the first number I want to point to, and I don't know if you can see my arrow, but 1913 in the lower left-hand corner right here, 1913. That's when the income tax, was really came into being. And, 1913, it was proposed to be a temporary tax. But here we fast forward 100 years later, and that tax is still in effect. But there's, this area right in here from 25 to 94, this upward slope. This is where, the Great Depression was going on. And then in 1939, World War II began. And right around the end, 1945, World War II end, our tax bracket was 94%. You go, how is that even possible in this country's history? Think about that. It was actually proposed at one point in time by Roosevelt to make it 100%, and they settled on 94%. So if your income was over $200,000, every dollar that you earned after that was taxed at 94%. That's insane. But they started to propose this that anybody that all you needed to live on was $25,000 a year, which equates to about $335,000 a year. They were trying to put income limits in this country, and it was shot down. Now, one of the actors back then that sort of was asked, why did he only do two movies a year? Said, because anything I earn after $200,000, I give it all to the government, because he lived in California. And that actor was Ronald Reagan, right? So when he was finally, during his term, one of the things he was able to do in the 80s was lower our tax bracket from 73% down to 28%. And, we had much more deductions back then, right? I mean, you could write off everything. And so it was on paper, it sounded awful, but practically speaking, a lot of people were able to get by because they were able to manipulate or find loopholes in the tax code. But now we look at this, and our highest tax bracket here is 37%. And it's going to sunset back to this higher one, 39% on 1/1/2026, like I talked about. And notice the green line in the middle. This is the mean. So 57%, right? It's probably 56 right now if I were to update this chart. So 56%, things tend to gravitate towards their mean. So if you have an account that you deferred your 401k in your IRA, you built it up to $1 million, you go, hey, I'm rich. Well, now let's put taxes on that, because all that money is not yours. So because it went into a qualified plan, 24% tax bracket, right? That means $240,000 going to the government. Now, if things go back, and let's say that, they sunset back over, like I said, just overnight without any market risk, just this is what I refer to as tax risk. 33% tax bracket, right? Now you only have the ability to spend $670,000. So this gentleman here, David Walker, I've talked about him before. I used to play his video, but he was the head of the Government Accounting Office, Board of Social Security, CPA Hall of Fame. He was a comptroller general on both sides of the aisle, right? He is quoted as saying, regardless of what politicians tell you, any additional accumulation of debt or absent dramatic reduction in the size and role of government, basically deferred tax increases. Unless we begin to get our fiscal house in order, there's simply no other way to handle our ever-mounting debt burdens except to double taxes over time. So look, what would that look like in that IRA example? We take that IRA, and now it went to 66%, which is just over the means. And now you only got spendable to buy of your $1 million, because the government kept $660,000 of that. You only get to spend $340,000. That's the problem. That's that usdebtclock.org. That is a ticking time bomb. Yet all of us. So Gene, hopefully you're getting my takeaway. Since I basically uncovered this back in 2008, and I've been screaming this from the rooftops. I do not own a 401k. I would never put another nickel in a qualified plan unless I was at an employer that did the match. That I'm okay with, right? Up to the match. So this is, basically just saying, hey, if we turn around and put in $10,000 into a qualified plan, and we kept things equal, we tax it at 20% on the way in, and we tax it at 20% on the way out, right? We gave it 30 years, gave it a reasonable rate of return of 5%. That at the end, after taxes, we end up at the exact same place. I've shown this before when I've done my tax horse race, right? 20% in, we end up, both tax deferred and tax free end up at the same place. But non-qualified money, CDs, brokerage accounts, any place where we get a 1099, the blue horse, that's the least efficient. And that's why, we have to have a plan how to basically unravel the tax traps that most Americans are facing. So now let's just do a 10% increases on the taxes. Now on the contribution or the deferral period, we did 20%. But when we took the money out, the government had no choice. They raised the taxes. That's the tax calculation part of the equation. Now what happens is we're up to 30% when we take the money out. We could have made a small mathematical error by deferring taxes into the future. And me personally, I don't trust the government as good stewards of our money. So that being said, right, this is our version of the horse race that basically says, hey, 30% now tax-free wins versus tax deferred. Now, the last thing here, and this is, I'm going to go through this, but as we think about it, and when you're pulling your Social Security statements and we're thinking about how much we earn through our life, these areas, the first portion, the first period is not, whether it's 10 years, let's say your first 10 years of your working career, you didn't start, you're out of high school, you're out of the Navy like me. I was in the military, I was happy to get a paycheck. So that money that goes in there is going to be taxed at the lowest bracket, right? 15% back then. But now, middle years, right, when we're, for that 30-year period. So let's say that now we're entering, familyhood. We're able to raise children, go get a job, and we make a little bit more money in 24%. But typically in the latter third of our life, right, we basically are earning more. We're higher income earners, and we're still even at the top tax bracket, right? That 30% withdrawal out of that money, right? Was it the best way to pull money out? And was it the most efficient? And we didn't know what we didn't know 10 years ago, 20 years ago, 30 years ago. So as we're starting to think about now going into the retirement, having and decoupling or disarming some of the tax traps that we've stepped into is really what we do at Professional Planning Services. We hope you understand what you got, how to start to disarm this stuff to figure out how to get more of our money tax free. So again, I showed this tax return last year. I'm sorry, last week. This is 2023. And last week I talked about tax exempt interest, right? Taxable interest, 1099. A lot of people save their money in CDs now. Banks are offering 5%. But if you get a 1099 and you're in a 25% tax bracket, you really netted 3.5%. Qualified dividends. So right, you're turning around, you're in a brokerage account, you got turnover on your mutual funds or whatever you got, right? So this is what we talked about last week. Where I want to start to focus on now, though, is once we start IRA distributions, and remember, they've kicked the can down the road. You got RMDs, required minimum distributions. It was at 70.5, but now with the Secure Act, they kicked that to Secure Act 1.0, kicked it to 72. Well, now they changed it to 73 with the Secure Act 2.0. And to me, I just smell a rat. I'm telling you that come, as we start to approach this and we get into our 70s and they start imputing us with income, what's that really going to affect? It's going to affect this Social Security benefits, and it's going to affect how much of that is taxable. Now, I'm doing a class at Rutgers this week on Social Security, and a lot of people, this is a complex system. It is subject to a completely different set of rules on Social Security, provisional income. So as you're doing this stuff and we're trying to piece all this together, how do all these pieces fit? And this is why dealing with somebody that's knowledgeable, right? Social Security is not allowed to give you advice, right? Most advisors, they just want to sell you a product or they want to put you into an investment. And they got no real understanding of how some of the ordering and withdrawal ordering of your wealth should actually be structured so that you can give less to the government and Uncle Sam. So that's my soapbox stand for this week. Basically next, like I said, this Saturday, I think I'm almost at capacity. There is still a little bit of seats open for the 27th. If you want to attend, feel free, reach out. Happy to see you. And again, hopefully you're finding the stuff that I'm bringing every week informative, insightful. It was timely. It's been a been a crazy month for me with taxes and stuff and Roth conversions and everything that I'm doing for clients. But we're here to help. And so if you got questions, we can be a resource for you. Let us know.